Dividends. So dividends are part of a company's profits that are paid out to shareholders. This is usually done semi-annually, and it's done as an amount per share. Companies don't essentially need to pay or aren't required to go and pay dividends. Many don't. You can find out the size of dividends per share for particular companies and when they're paid on the FNArena website or on the ASX site. It's important to note that dividends reduce the overall value of a company. So when trading and there's a dividend coming up, if you're long, if you're a shareholder, you're going to be entitled to receive these dividends as cash. However, your underlying or your capital is going to reduce in value by a similar amount. This is because dividends are paid out of profits. So essentially you've got company XYZ with a few $100 million sitting on its balance sheet prior to dividend or ex-dividend date. On the day of the dividend, these are allocated, this money's paid out. It's allocated to the shareholders and it reduces the overall value of the particular company. So, usually you'll find on the ex-div date, the shares lose a very similar amount to the actual dividend and quite often inclusive of the franking credits. Now just to recap, franking credits are the amount tax paid by the company at the corporate tax rate. So essentially, companies go out and pay at 30%. The tax on any of the dividends if they have a fully franked dividend. Now this is written usually in percentage terms, but we'll analyse franking credits a little bit further along. So pure equity pays no dividend, pure debt has no capital upside. A yielding stock or a dividend paying stock is somewhere in between these two. Important thing to note with dividends is the amount per share generally grows as company profits increase. So this can lead to a significant increase in earnings or yield on your investment over time. So what are these franking credits? Franking credits are the tax paid at the corporate tax rate over dividends. So essentially, it means a company's gone out and actually paid the tax on your income. Now, let's analyse how they do this. First of all, it's important to note that there is a percentage rate, so not always are they paying the entire amount of tax. If a company is paying the entire tax, or the corporate tax rate over a position, what we call this is 100% fully franked. Now, companies quite often pay 30, 50, or all sorts of different ranges of tax on the position. So it's important to take that into consideration. A 100% franked dividend of, let's say, $100 essentially means that $30 tax has already been paid on that position. Now, depending on your individual tax position, you may get money back from this, you may have to pay more tax on the position. Franking credits, as I said, can range right from 10 right through to 100%. So work this out first before you start to analyse how much tax has actually been paid on your position. Another important thing to note when analysing franking credits is that on the particular day, which we call the ex-div date, which is when a company pays out its dividends, quite often you'll find that the stock loses the full amount of the dividend as well as the amount of the franking credit, because this is money that the company's paid out of its profits as well. So important to take that into consideration when analysing what will happen on the ex-div date. So what is diversification? Diversification is a risk reduction exercise. Shares carry a significant amount of company risk. To reduce this, investors generally buy a portfolio of stock. Diversification should be achieved across the entire industry sector, not just stock specific. So you should try, if you're aiming to achieve a significant level of diversification in your portfolio, you should try and diversify amongst industries. So you've got your resources, your financials, your healthcare, right across the board, rather than looking for a whole heap of different stocks within one sector. Now, diversification essentially reduces the effect of a significant fall in one of your stocks, or one particular stock that you're holding. But the overall effect of this is by reducing the volatility of returns. So your investment performance will have a lot less volatility in it, which means it's easier to enter or exit your position at any particular time. Okay, now we're looking at how to place orders in the market. There are two different types of orders. We have an at market or an at best order, and we have a limit order. Now it's important to note the difference between these two, especially if you're trading through a trading platform where it takes this information and places your order on your behalf. Now let's analyse initially an at best order. An at best order basically means we go into the market and we fill that position at the best possible price at that particular time. Now what this means is we essentially, if we're a buyer, we go into the market and we hit a seller, the first available seller, we hit their price, and complete the transaction. As a seller, we go into the market and we hit the highest buyer and sell out of our position immediately. So a market order always happens almost instantly. A limit order, however, is an order placed at a particular price. So we're not prepared to buy or sell the position for anything more or less than that particular amount. We're limiting ourselves to that level. It's very important to notify the difference, especially if you're entering it into your system yourself. But even if you're talking to a broker, make sure you specify this is an at best or this is a limit order, willing to buy up to this price or sell down to this particular price. Dividend reinvestment plans, DRPs, allows reinvestment of dividends back into your shareholding. Now, not all companies do dividend reinvestment plans. Now, what happens basically is a company will send you some statements showing your positions and offer the dividend reinvestment plan. It's simply a matter of filling out the appropriate paperwork and sending it back to the underlying company, and they'll manage it all on your behalf. So what happens here is on the ex-dividend date, instead of being paid out cash, you're actually use that cash to purchase new shares into the market.